So I get asked every few hours, right about now, on November 15th, what the outcome of the election is and what its impact on markets is. And said simply, I think everybody knows what's gone on to date with the Senate and Republicans losing a seat that they may regain in Georgia, may not, with a runoff that's in December 6th, or starting basically now and running through December 6th. The House of Representatives is one where the Republicans, as I speak, are one seat away from taking formal control of the House. There's currently 4 seats where the Republicans, undecided seats, where the Republicans lead and are in districts where most of the uncounted ballots are in Republican turf, and therefore they'll certainly get over 218, may well get up to 221. There's a few more that could go either way. Maybe they get a little higher than that, but they certainly take control of the House. And what that means fundamentally is now you have the Senate controlled by the Democrats. Republicans will hold the House. That means that the only bills that can make it through both chambers and go to the president's desk are things that people pretty commonly agree upon, and there's not a whole lot of that. So they can't be very controversial, they can't be too big, they can't be too scary. And this is what's called hardcore gridlock. The president's party has the Senate and the presidency and not the House. And gridlock's traditionally good for stocks. The 3 quarters, 9 months that begin with the beginning of October in a midterm election year, those 9 months are the most consistently positive period in U.S. stock market history, in fact, global stock market history. Any way you slice it, every which way, good times, bad times, could be a 9-month good run in an otherwise bad market, could be the beginning of a bull market, which is what I think happened in October. But I could be wrong about that. Regardless, I'm going to say it's the most consistently positive 9 months. That 9 months has only been negative twice. In a period we've had good, accurate stock market history, and it's going back to 1925, and the last time was as World War II started. Average annual returns over that 9-month period are not quite 20%, 19.5%. Not only is that true, in the history of major European stock indexes, it's never been negative. There's a high correlation between U.S. and foreign, and most Europeans pay a lot of attention to U.S. politics. The reason that this thing works is pretty simple, not well understood, and almost no one believes it, but that because almost no one believes it, that's part of why it works, is intuitively you know in your bones, and a couple of behavioral psychologists named Richard Thaler and Salmo Bernarzi proved this decades ago. The average American hates losses about 2.5 times as much as they love gains, and big controversial legislation always impacts either taxes or property rights or regulation, all of them. And whoever they help like it, but whoever they hinder, because to help somebody you got to hinder somebody else, they hate it even more. They hate it more than the people that like it. And for an American, that's about 2.5 to 1. For Europeans, that's more than that. Again, a very long time ago, Mayor Statman and I documented, using the Thaler-Bernarzi methodology exactly the same way, and data from Britain and Germany, that the average British person hates losses 4 times as much as they like gains. The average German, 6 times as much. Europeans overall are just much more loss averse. The fact is, as we all focus on the power of the politics of the most important economy in the world, what that does when there's big legislation is it scares. But the president's party always knows when they first take office, right after the president's inauguration, that in the midterms, almost always, the president's party loses relative power to the opposition party, a little or a lot. This time, hardcore gridlock. But because the president's party knows that when the president's first elected, they know that they have to get whatever is their biggest, most controversial legislation through in their first 2 years, because if they can't pass it in their first 2 years, they'll never get it passed after those midterms. So they push in those first two. And for all intents and purposes, all big controversial legislation in American history almost perfectly comes in the first 2 years, doesn't come in the back two. After the midterms, you still get talking, yakking rhetoric, but legislative reality becomes much calmer. Markets pre-price that, sometimes before the election, sometimes right after. This year we've had a good 6.5% run starting the day after the election. And market was up before that during the quarter. It's a strong run. The fact is, what the market's pre-pricing is that quiet that comes from the gridlock. That extends over into the first and second quarters of the next year, the president's third year in his term. We haven't had a negative third year of a president's term since 1939, which was only down 0.9% as World War II was starting. Again, linked to that one period where what I call Midterm Miracle of those 9 months was negative. So what I want you to see is that the election you may have liked as a Democrat a little bit because it came out better than Democrats expected it to. You may have hated as a Republican because it came out a little worse overall than Republicans hoped it would. In fact, quite a lot worse. They hoped for the big red wave that didn't happen. But for the stock market, you still get gridlock. And that's good for investment returns, good for stock market returns. And if I were you, I would think of it as maybe what I like politically, maybe what I dislike politically, but what you do like stock market-wise. Thank you for listening to me. Subscribe to the Fisher Investment YouTube channel if you like what you've seen. Click the bell to be notified as soon as we publish new videos.